You're listening to Uranium Spotlight, brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, Namibia reclaims center stage in global uranium supply. UxC warns of U.S. nuclear execution risks. India unveils ambitious small reactor rollout, and uranium markets signal the next bull run. The uranium spot price closed last week at $72.20 a pound, down $5.30 from the prior week's $77.50. The decline capped a choppy week in the spot market, marked by sellers softening offers to attract buyers after the holiday lull. Early in the week, the spot price fell sharply, with single deals reported at $75.25 Monday, $74 on Tuesday, and then dropping further to $71.70 by Wednesday. But by Thursday and Friday, the market showed tentative signs of stabilization, ticking up slightly to end the week at $72.20 on modest buying interest. Volume was moderate, with 6 spot transactions totaling just under 600,000 pounds U3O8. Notably, the Sprott Physical Uranium Trust remained an active buyer, though falling prices also drew in few other players. Year-to-date spot volume now stands at about 28.6 million pounds across 219 transactions, with over 60% of those for prompt delivery. On the term side, demand stayed quiet last week, though several U.S. and non-U.S. utilities continue evaluating long-term offers, with tenders on the table for delivery starting as early as 2025 and stretching into the 2030s. This week, market participants will be watching closely for signals from the NEI Nuclear Fuel Supply Forum in Washington, which could set the tone heading into the second half of July. For uranium investors, last week's retreat highlights just how thin and reactive this market can be, and why disciplined longer-term fundamentals still drive the story despite near-term volatility. If you haven't already, be sure to subscribe to Uranium Spotlight podcast, available on your favorite podcast platform or on Purepoint Uranium's YouTube channel. Since the recent coup in Niger, which saw the country pivot away from Western allies like France and towards Russia, China, and Turkey, France has been forced to find new sources for its uranium. Niger had supplied about 20% of France's needs, with French state-owned Orano operating the mines there until the new Nigerian government nationalized the operations. In response, Orano is now revisiting its dormant project in Namibia, a mine that received environmental approval back in 2008. At the time, Orano invested in test projects and advanced the mine to about 60% of full capacity by 2013, even producing small amounts of uranium. But as uranium prices collapsed, the project was put on care and maintenance. Today, Orano is conducting a full feasibility study, including fresh drilling and updated environmental assessments to determine whether the mine can be brought online soon. Notably, Orano already operates a desalination plant in the area, originally built to support this mine, which has continued supplying water to other nearby uranium operations during the care and maintenance period. These neighboring mines include Namibia's 3 other major uranium producers, Rosing, Husab, and Langer Heinrich. Langer Heinrich, owned by Australia's Paladin Energy, has faced production setbacks this year after heavy rains forced the company to withdraw its 2025 production guidance and deal with mounting legal challenges in Australia. Rosing, owned by China National Nuclear Corporation, or CNNC, is planning to expand into a nearby deposit to boost output to meet China's growing demand. CNNC, through its subsidiary China National Uranium, supplies much of its own fuel. Husab, meanwhile, is owned by China General Nuclear, the other major Chinese nuclear company, and the Namibian state holds a 10% stake there through its national mining company. Namibia's government maintains control over exploration and future development, though it remains open to joint ventures and has reiterated that existing operations will not be nationalized, despite earlier fears following a controversial 2010 deal with Russia's ARMZ that ultimately went nowhere. However, recent agreements with Russia's Rosatom to explore enrichment and other nuclear activities have raised questions about Namibia's geopolitical leanings. For investors, Namibia is a critical piece of the global uranium puzzle. As the world's 3rd largest producer, its stability and openness to Western companies remain essential to the security of supply. With Niger off the table for now and production hiccups elsewhere, the industry's balance is precarious, and Namibia's next moves will be watched closely. Last week, uranium consultancy UXC published an editorial warning that if the United States is serious about delivering the golden age of artificial intelligence and domestic manufacturing the current administration envisions, it will also require a sweeping nuclear revival, one that has been promised for decades but never fully realized. UXC draws a parallel to what it calls Manhattan Project 2.0, the massive U.S. reactor build-out of the 1970s. At the time, the goal was an ambitious 1,200 gigawatts of nuclear capacity by the year 2000. That would have been equivalent to roughly 1,200 large-scale reactors, enough to power the entire U.S. grid today. But the program fell short. Oil and gas prices fell, enthusiasm waned, and more than 200 planned or approved reactors were never built. Now, UXC argues we're entering Manhattan Project 3.0. The difference this time is that rather than pouring in massive funding and manpower, the current approach relies on deregulation, removing barriers and imposing tighter approval deadlines, but without corresponding increases in funding or agency capacity to keep up with the workload. According to UXC, this mismatch could actually slow down, not accelerate, the nuclear build-out. For uranium investors, the takeaway is clear. The rhetoric around nuclear in the U.S. remains strong, and the structural need for new baseload generation continues to grow. But the policy execution risks are real, and timelines for reactor demand may stretch if regulatory bottlenecks aren't addressed. In the meantime, uranium prices and equities will likely continue to respond more to near-term supply constraints and global demand growth rather than long-dated U.S. ambitions. Indian Oil has unveiled a plan to install nuclear reactors at each of its refineries. The company says a 200-megawatt Bharat small reactor at a single plant could power that facility indefinitely, significantly cutting emissions across India's oil and gas sector. These Bharat small reactors are a homegrown Indian technology that's been in use for decades, now being adapted specifically to serve heavy industry and critical infrastructure like refineries. The idea is to take these large industrial consumers off the national grid, freeing up electricity for the population while giving industry a reliable, low-carbon energy source. Indian Oil, one of the country's largest oil and gas players, has been exploring this concept with India's state-owned nuclear authority, NPCIL, for over a decade, and they're not alone. Other industrial giants, Reliance, Adani, Greenko, Vedanta, Vinalco, JSW, and HPCL Mitel, have all been in discussions with NPCIL about deploying Bharat small reactors at their operations. Even NTPC, India's largest utility and operator of coal-fired power plants, is looking to integrate nuclear into its portfolio. The scale of ambition here is significant. The Indian government has set a target of building 100 gigawatts of nuclear capacity, equivalent to about 100 large reactors, plus nearly 5 times that number of Bharat small reactors by 2047. For uranium investors, this is a clear signal of growing long-term demand. Meeting these targets will require enormous planning, capital, and crucially, fuel. If India follows through, the call on uranium supply could increase substantially in the coming decades, adding another pillar of demand to an already tightening global market. June was a turning point for uranium markets. Spot uranium rose nearly 10% to $78.50 a pound, its strongest month of a year, while uranium miners surged 18% and juniors gained almost as much. These moves reflect renewed institutional capital, improved sentiment, and the structural supply deficit finally asserting itself in pricing. Policy support continues to build. The World Bank reversed its ban on nuclear project funding, and the U.S. passed the Big Beautiful Bill, streamlining NRC licensing and preserving tax credits, and states like New York and countries across Europe announcing major new nuclear investments. Together, these policies clear regulatory overhangs, de-risk development, and point to a much larger, more durable demand base. One surprising driver, artificial intelligence. Power-hungry data centers are turning to nuclear for reliable, zero-carbon electricity. In June, Amazon and Talon Energy inked a deal for nearly 2 gigawatts of nuclear power. Across the U.S., over 28 gigawatts of nuclear capacity has now been tied to AI and digital infrastructure, adding a long-cycle, price-insensitive demand layer for uranium. Looking ahead, utilities remain behind in contracting volumes, even as uncovered requirements grow and geopolitical risks, like Niger's mine nationalization, highlight supply fragility. With contracting lead times shortening and the World Nuclear Association's September forecast on deck, the setup into year-end looks bullish. For investors, these trends suggest uranium's fundamentals are strengthening, with equities offering leverage as sentiment and contracting catch up to reality. The next leg of the bull market may already be underway. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.